Think we're on. Okay. Today at Decentrlised Life, we have the privilege of interviewing Rick Rule, who has been a natural resource investor, among other things, for most of his life. And he's been quite good at it. So, Rick, thanks for coming on today. If you could start by maybe just giving a little brief backstory as to how you now find yourself where you are in your life and how you got there.
Oh, thank you, Mr. Holmes. I'm delighted to speak on decentralized life. I think that's a great concept, and I look forward to aiding people in their search for a decentralized life. I'm a 68-year-old recently. By recently, I mean March 15th, retired natural resource investment manager. I started in the resource business in the 1970s at the ripe old age of 21 or 22. I've been fortunate enough that I chose my career fairly well and stayed with it in various forms ever since. Part and parcel with that, I guess, away from resources, one would describe my politics or sociology as somewhere between libertarian and anarcho-capitalist, which is just decidedly distributed, decentralized. Mm-hmm. I think that's common among particularly people who end up being attracted to precious metals investing, which is, of course, a subset of natural resource investing. I've been part of being an investment manager, which is to say assisting other people in investing in natural resources. I've also been prominently an investor for my own account, which has worked out very well for me. I'll try to make the point in this interview, to the extent that I'm able, that being a natural resource investor, because of the capital-intensive cyclical nature of the businesses, involves by necessity being a contrarian. I would argue that these are the most capital-intensive cyclical businesses on the planet. And the consequence of that is that you are either a contrarian or you are going to be a victim. It's an important starting point to understand that people who don't have the courage to go against sort of popular paradigms will end up very badly in natural resource-based businesses. It's only people who are very forward-thinking, while at the same time having a high regard for history, that do well in these businesses. They're not like other businesses.
Mm-hmm. Yeah, I think I agree with that. I think taking on what you said about libertarian views, it seems, I could be wrong, but it seems to me that libertarian these days has taken on a different meaning from maybe what it used to mean.
And I may not be a classic libertarian in the sense that the idea that people who don't believe in politics have a party has always struck me as being sort of an oxymoron. Yeah. Probably I would describe myself, if I had to be labeled, as a voluntarist. I believe that relationships between people should be voluntary and contractual. I don't believe that one has the right to initiate the use of force or violence against somebody else except in self-defense. And the whole political process of using the instrument of the state to cause your own particular belief system to constitute a restriction on somebody else seems to me to be immoral. Odd way to start an investment discussion, but probably it's part and parcel with some of my beliefs.
Yeah. So I wanted to do the overall focus today of more or less advice for young people or young families that have been, wanting to get into investing and are maybe unsure on, what's the best way. And so I wanted to focus on why perhaps gold and silver might play an important role in somebody's investment portfolio, and as to why things like research are very important, and not just jumping into something because one of your friends made a bunch of money at it, and you'd be late to the party essentially.
Yeah, that's probably the worst reason. To the extent that the great unwashed has done well in a certain sector, which is to say our friends, probably means in a cyclical business that it's over. And the very fact that they were successful, not knowing what they were doing, suggests that the sector itself has worn out its welcome. But I'd like to back up a bit, if I may, Mr. Holmes, and say for young people, the most important investment they can make is not in gold and silver, but rather in themselves, investing in their own education, investing in their skill sets. That will pay the highest return over time. It turns out that knowledge can't be taxed or stolen. It can be lost, to be sure, and the benefit from it can, of course, be taxed or stolen. But young investors in particular need to invest both time and treasure in building their ability to analyze and building their education. With regards to investments, before we talk about gold and silver, I'd like to talk about 4 books that I think are important, maybe 5. Start with Economics in One Lesson by Hazlitt, which teaches you about economics as they are, as opposed to the way that the big thinkers would like them to be. An easy book to read, and it's important to get an economic grounding in order to be an investor. From there, proceed to The Intelligent Investor by Ben Graham. Simply the best investment book ever written relative to the effort required to read it, which is easy. If you like that book, then proceed to Securities Analysis, also by Graham. Simply the best investment book ever written, but not easy to read. A great cure for insomnia, but a wonderful book. In fact, I would go so far as to say if your young readers read Securities Analysis, don't buy it, I mean read it, and employ the lessons that no ifs, ands, or buts, they will get rich. But you need to read the book and you need to employ the lessons. Having suffered through that, if you still have a sense of humor for my course of thinking, Human Action by von Mises was probably the most impactful book of my life. It talks about volition, it talks about will, it talks about people, the way people act and think the way they do, both as individuals and groups. Those 4 books will be a substantial investment in education. People who suffer through all of those and employ the lessons will do well, almost irrespective of the type of investment that they participate in. That commercial over, I would urge your young people to regard gold or silver in the first analysis, not so much as an investment, but rather as a form of insurance. Precious metals investments have done well over time, and by time I mean millennia. When people were concerned about the efficacy of other savings products in terms of its impact on their ongoing purchasing power. One might think of it differently as legislature insurance. If you trust your parliament, if you trust your Congress, implicitly, if you think the big thinkers of the world should run your financials, you have no use for gold or silver. If, by contrast, you are concerned about the way voters and your elected representatives run your life, then I think you need to own gold or silver all the time for insurance, and own it in that part of your portfolio, at least, while praying, if you pray, that the price doesn't go up. Any kind of insurance you get paid off supposes a bad outcome. Life insurance means somebody died. Auto insurance means you had a wreck. Home insurance means your house burned down. These are all bad circumstances. And the set of circumstances that causes gold to do well, think of it as social insurance. When there is a breakdown in social trust, when there is a breakdown between the political class and the rest of society, gold does very well, but it's invariably a very unpleasant circumstance. The second thing that people need to know about gold or silver, though, is that they are extremely cyclical and extremely volatile. So after you've laid in a base amount, whichever amount you think is reasonable for yourself as insurance, you can think about it in an investing sense. But then you need to study some history. You need to look at the DNA, if you will, the path of previous bull markets and previous bear markets, understanding that gold always recovers from oversold bottoms during periods of confidence, goes up in periods of lack of confidence, but it's extremely cyclical and it's extremely volatile. Cyclical declines of as much as 25% on the gold price are common in secular gold bull markets. And people who don't understand why they own gold or silver are very easily shaken out of secular bull markets by cyclical declines. I'll refer later in this article, pardon me, in this discussion, to a chart which I'm happy to offer your subscribers, the Barron's Gold Mining Index, which tracks in a very broad-ranging equities index 50 years of the ups and downs of the gold bull market. I'm not suggesting that people look at it from the view to doing technical analysis, but rather from the view to having a wonderful graphic to put all of the narrative that we're going to talk about in the next little while into perspective.
Sorry about the Barron's
Yes,
chart.
sir.
Yeah.
Yes.
Yeah. No, I think that would be. I've looked at it several times, and it's pretty interesting.
It's extremely instructive.
Yeah.
It's extremely instructive.
So okay. So the first takeaway here is that the first and foremost investment should be in yourself.
Correct.
And especially in educating yourself with books and knowledge about investing.
Correct. And in terms of your profession, you know,
Yeah.
if I'm very lucky in that I joke I would do what I do for free if it didn't pay so well, which means it's very difficult for other people to compete with me. It is easy to generate utility and value in a sector where you are up early, eager to go to work, and you stop working only grudgingly, and then work very hard when you're at it. I have found in business, different than in investing, but in business, you make money by delivering utility to others, and study is required in the same circumstance. If you understand your trade, your craft, your profession, whatever it is, and you like it, and you don't focus on how much you get paid, but rather you focus on how much utility you deliver to others, you become indispensable to your customers. And your customers will pay a lot to you if you're indispensable, provided that you give them more than you get. And so in that sense, investing in yourself is important too. You are your tool.
Yeah, if you can deliver yourself value, then the rest will follow. So yeah, okay. So using gold or silver as some sort of insurance or a hedge, I suppose, is that one reason with the global goings on to consider that gold and silver may be or are in a bull market? Or I suppose the overall question is, what are the reasons to believe that gold and silver are in the innings of a bull market?
I think a study of history would suggest that the price action in gold and silver indicate that they are in a bull market. More importantly, the reasons why gold and silver would be in a bull market are all true. Let's list them. We talked earlier about the fact that gold does well when social trust breaks down. And I would argue that it's fairly obvious that social trust is breaking down. Gold does well too when people are concerned about the ongoing purchasing power of their savings denominated in conventional instruments, in particular the world's reserve currency, which is to say the US dollar. So let's look at a few factors. Quantitative easing, that is the precisely. If you did it, if you started printing up homes, they would throw you in prison unless you were a member of the legislature, in which case you would be popular and reelected. But the fact that you conjure up specious currency units is debasing the currency by definition, which obviously and rationally creates a crisis of confidence in the efficacy of the currency. More importantly, probably, in the longer term, are debt and deficits. The obligations of society. A former president of the United States said it didn't matter because we owed them to each other. Wrong. The spenders owe them to the savers. And the spenders are more numerous in society than savers. So it does matter. And in fact, it matters a lot. I don't know the nationality of all your viewers, so I'll confine my insults to the American government. But collectively, we owe ourselves 28 trillion. That's 12 zeros after the 28.
On balance sheet, yeah.
On balance sheet liabilities, which is to say bonds. Now, 22 net of the Fed's own balance sheet. But astonishingly, we owe $120 trillion in off-balance sheet, net present value of off-balance sheet obligations, things like Medicare, Medicaid, Social Security. So at the federal level, not state and local, we owe running on $150 trillion. We propose to service this with the national income, which is taxes and fees, less expenses. The problem is that far from servicing $150 trillion, we add to it by $3 trillion a year. Your young viewers probably have done enough arithmetic that they know that you can't add a column of negative numbers and come up with a positive sum. But this debt is unserviceable, which by definition causes a crisis in confidence in the currency.
Yeah.
More important, I'm sorry?
Sorry. Most, using the US is a good example, but most other nations are in a similar state to varying degrees.
Or ironically worse.
Yeah.
My friend Doug Casey says that the US dollar is the worst currency in the world with the sole exception of every other one.
Yeah, yeah, I've watched quite a lot of Doug stuff as well.
Moving on, nominal and real interest rates. A negative real interest rate is not a force of nature. The idea, interest is supposed to be your compensation for foregoing consumption in favor of somebody else who wants to consume sooner. And the interest itself is supposed to be both compensation, but it's also supposed to be insurance against time value of money, the degradation of purchasing power, and the credit quality of the issuer. The idea that you would pay somebody to borrow money from you with the sole promise that they give you back less than you gave them is obviously not a natural circumstance, and it obviously penalizes savers. So the most important determinant of the gold price, I think, is nominal and real interest rates, particularly those around the US 10-year Treasury, which is widely regarded as the benchmark, the world's benchmark security.
And it would seem that raising key rates significantly or to historic averages would be highly unlikely in the near term.
I suggest it would be highly unlikely. If, as an example, you look at the 30-year mean US Treasury rate, it was 150 basis points positive, which is to say you take the nominal yield on the US 10-year Treasury and you add back the CPI rate of inflation. So right now with the 10-year yielding 175 bips and the trailing CPI rate of inflation at 160 bips, what does that give you? 3.3% on the US 10-year Treasury. If you were to increase the interest yield on the US 10-year Treasury to 3.3, think what that might do to the 30-year mortgage rate or to the refund rate on short-term debt for federal, state, and local governments. I think it's unlikely. But you ask, how can we tell that we're in a bull market for gold? If a bull market for gold corresponds to a bear market for credit, which is to say bonds, quantitative easing, debt and deficits, that is poor credit quality, and a negative real interest rate are the reasons for the driver in gold. If you see those three factors change, then you'll know that the gold market is long of tooth and it's time to find something else that's out of favor, at least for the investment portion of your gold holdings.
I mean, for me, I have a hard time finding reasons why gold should not be in a bull market. I can find more reasons as to why it should be than it shouldn't be.
It's very easy for me to agree with you because I have felt the way I do for a very long time, and I'm guilty of confirmation bias. The one thing that always sticks in my mind is Warren Buffett's description of gold as a pet rock. Its utility seems to be, yes, there are utilities. I mean, it conducts electricity wonderfully well. It's indestructible, it's divisible, it's consistent. I remember all of the Aristotle arguments around gold. You know, I get all that. It's one of the few instruments in the world that isn't a promise to pay. It's rather its payment itself. You know, a dollar bill actually is credit. It's the unsecured obligation of US society. Gold is not. But one always wonders why, other than luster, divisibility, and consistency, why gold has value. I struggle with that. But then I look at 6,000 years of recorded history, And I see that in places like South Asia, Europe, South America, East Europe, Eastern Europe, East Asia, between 4,000 to 6,000 years ago, gold fulfilled the same function for many societies, and perhaps gold's value is that gold is regarded by people as having value.
So it's unlikely to change.
That's my belief, certainly.
Yeah.
My belief, certainly. It's certainly unlikely to change before, as an example, the US dollar or the British pound or the euro change. Over a long period of time, yes, but nobody counterfeits gold. You make more, but nobody counterfeits it. And as I say, it isn't merely a medium of exchange. It's simultaneously a medium of exchange and a store of value. And it has utility separate and apart from all that, as religious iconography, as jewelry, as a component in microelectronics. So it's uniquely suited probably to be money.
Perhaps less utility than something like silver, but utility nonetheless. And
yes.
Okay. I think you've more or less answered the first couple of questions pretty well, going into the fiat currencies and deficits, and there's a lot floating around these days is to do with MMT as a way to kind of justify things that don't make sense and trying to say that they do make sense. These are, I suppose, all reasons to believe that gold and silver are in a bull market. But why haven't people caught on in terms of the percentage of people owning gold is less than average?
With the caveat that I'm not a social scientist. I mean, I haven't owned a TV for many years, so popular culture is not one of my strong suits. I would suggest that there are several reasons for this. The first has been that there has been a bull market in government and confidence and credit for 40 years, going back to 1982, when the US at least temporarily broke the back of inflation. People didn't see the need to own gold, and it didn't perform. Deposit products, US treasuries, equities, everything did well in a declining interest rate environment. We had 40 years of a Goldilocks environment. It doesn't mean that our patience wasn't occasionally tested. The 1987 decline, the tech wreck, 2001, 2008, the COVID crisis. But in every circumstance, although people's faith, certainly in the equities markets as measured by the S&P 500, got challenged, buying the dips turned out to be a great strategy. Declining real interest rates is a Goldilocks environment. If you look at that trend in motion, remember that the US 10-year Treasury troughed, or rather the yield peaked in 1982 at 15.6. It fell as low as 60 basis points. Now, I'm not trying to say that that bull market is necessarily over, but it seems to me to be closer to the end after 40 years than to the beginning. And if you come to the view that I hold, that gold measures the inverse of confidence, the inverse of the long bond. If you believe that the long bond bull market is pretty much over, then you believe that the gold bull market is in nascent stages. Which is why I believe, and I believe it as a consequence of, as I say, quantitative easing, debt and deficits, and real interest rates.
How would you say, to getting away from gold and silver at the moment, but how would you say to young people to try to avoid the hype? What would you suggest?
Well, are we talking about gold and silver, or just generally?
Just in general, can include gold and silver, but there's lots.
I say recency bias. Recency bias is a huge problem, and volition is a huge problem. Recency bias means that circumstances that have occurred in the immediate past are more recognizable to us than things that have happened in the more distant past. And the consequence of that is that in ebullient times, bull markets go longer than they should have gone because people tend to get swept up in the phrase. If you've made money even on your mistakes in a sector, you come to believe that you understand the sector and the sector is benign. And as that confidence gets more broadly spread, the pricing signals that you see continue to justify the narrative. It's odd that, as an example, when gold was at $1,900, it was substantially more popular than it had been 2.5 years before at $1,000.
Yeah.
If nothing underlying had changed, the fact that the gold price doubled meant it was half as attractive, but twice as popular.
It's a psychological problem.
It is.
I was rather early on gold. I was in 2016, and been sitting there since. But
in a circumstance where an asset that you hold as insurance goes up in price,
doesn't matter.
so that's the nicest possible circumstance that you can have. What it means is that your insurance premium is negative. And from a financial point of view, that's a blessing.
Yeah, it was. Well, I suppose some people can't handle the volatility, I suppose, and it's never fun to look at your portfolio and see it consistently going down.
People make a mistake that way, I think. I think that almost all investors, not just young investors, almost all investors pay slavish attention to price without having an opinion as to value. And money is made on the delta between price and value. It's odd, but true, that if somebody owns a stock at $10 and they see it go to $20 and nothing has changed with the company, arithmetically, that company is half as attractive, but the investor likes it twice as much. Yes.
Yeah.
Similarly, if you held a stock at $10 and it went to $5 and nothing had changed with the company, it was precisely twice as attractive. But the truth is that most people aren't willing to do the work to form an opinion as to value, but they can get price with no effort whatsoever. But price is an absolutely useless statistic, absolutely useless if you don't have a value to juxtapose it to. 1% of investors recognize that. If you don't have a sense of what something is worth, if you see it decline in price by 25 or 30%, you get scared. I can tell you there have been 70 or 80 occasions in my life where I owned a stock and it wasn't for sale at the price it was selling for because I had higher aspirations for it, and it fell substantially, and I felt it a blessing. I was able to use more physical capital to justify the same intellectual capital that I already spent on understanding value, and it worked to my benefit. I'll go further than that. In speculation, which I've done a lot of in my life, and I've been very, very, very lucky. I've been involved in scores of stocks that have been 10-baggers, which is to say I've enjoyed 1,000% gains. What is instructive to me now is that the average time span that it took me to make 1,000% was between 5 and 6 years. Most investors seem to have trauma holding stock over a long weekend. But going to volatility, the average 10-bagger that I've enjoyed has handed me 2 separate 50% declines during the period of time that I owned them. So you had to have enough courage of your conviction. You had to have enough sense of what the value was or what the value was going to be, that you had both the financial and the psychological wherewithal to stomach a 50% decline, which takes some doing.
So to help you stomach it, what would you say, if it goes down sharply, go check the company, do some research, have the fundamentals changed.
Yeah,
Nothing's
check your precept.
changed, then don't worry, basically.
Absolutely check your precept. If you're wrong, figure out what changed.
Yeah.
If the reason to own the stock goes away, then for sure the stock has to go away. If you own the stock for a reason, turns out that reason was incorrect, then yes, despite the fact that you're down 30% or 40%, when the reason to own a stock goes away, hope is not an investment strategy. The stock has to go away. You have to sell mistakes. You recognize the psychological failure before the financial failure gets too extreme to come back from. But in those circumstances where the price declines but the value doesn't, you owe it to your future to load up on a bargain. You know, if you or your wife went to the store wherever you live and there was a brand of tuna fish that your family enjoyed and you thought that $2 a can was a good price for tuna fish. I don't know what tuna fish sells for, but let's just say. And you went to the store and tuna fish was on sale for $1 a can.
Love it.
You'd likely buy a case.
Yeah.
If by contrast you went back and the tuna fish was at $4 a can, you would likely substitute chicken or salmon or something like that. But people don't do that with stocks. The fact is, if the $2 can gets marked up to $4, then they buy the case. When it's the same damn tuna. It's an odd circumstance the way people think.
I find it difficult though to try to help somebody understand why something that is really down the toilet might actually be worthwhile as an investment, as opposed to something that's made new highs.
Well, it's a function of being willing to do the work. What is it worth? People pay attention to price. They don't pay attention to value. I'm lucky in that regard, I guess, because my vocation, in addition to securities analysis, has been credit analysis. And if I see a company with $100 million market cap, one of the things I like to do is look at the assets, look at the income statement and say, how much would I be willing to lend these guys? If there's a company with $100 million worth of market cap and there's $10 million worth of realizable collateral, there better be a hell of a lot of upside because my downside is 90%. I really think it's all about a juxtaposition of price to value.
Yeah. And sometimes you're lucky enough to find companies where the market cap is smaller than their assets.
When I came into the business in the 70s, Warren Buffett had what he called the holy grail of sixes. The holy grail of sixes was a company that was selling at 60% of book, less than 6 times earnings, and paid a 6% dividend. Now, those are cheap businesses, but remember, during the period of time of the 70s, people were afraid of everything, particularly afraid of equities.
Those are difficult to find right now.
His Mr. Buffett's guru was Ben Graham, and Ben Graham was even stricter on valuation. Mr. Graham wanted to buy companies that were cash flow positive, that sold at a discount to net working capital, which is to say, if you added market capitalization and debt, that current assets, cash and inventory, was greater. In other words, he called them free bonds, where you got an earnings yield for free after current assets. Those are hardcore values. And as you say, the consequence of the decline in interest rates and the escalation in price, at least nominal price of everything, has made circumstances like that extremely rare, except in countries that some people are afraid, either rationally or irrationally, from investing in.
Yeah, no, I think that's a pretty good explanation. I think. Do you think it's hard for value investors these days?
No. It's hard for value investors that suffer from FOMO, fear of missing out. I'm not one of those. I have a lecture that talks about the 2 principal form of errors of omission and errors of commission. An error of omission is money that you could have made had you made the investment. An error of commission is where you lose money. Errors of commission are much worse than errors of omission. Errors of omission are, oh, bad, oh, sad, too bad, that kind of thing. Errors of commission, you're out of money. I love value investing. I love to sleep nights, stay calm, and have time working for me. Interestingly, these are fairly easy times to be value investing, except that you need to go in businesses that are mundane. You need to bore the hell out of people at cocktail parties. And you need to be immune to fear on missing out. You know, the idea that there's some private equity guy that turned up $1 billion market cap on a company that loses $120 million a year, in a business that you can't understand, maybe even can't pronounce. The idea that you weren't lucky enough to partake in that doesn't matter. It doesn't change your decision as to what to have for breakfast. It's absolutely irrelevant. You didn't make or lose money on it. So from a value investor's point of view, this isn't a bad time. Actually, the price of things is very high. So you need to go places where others might, or into businesses where others might. But it's not hard to be a value investor today.
Just maybe structure a little bit more.
Yeah, maybe it helps to be old, like me.
All right. Given, you know, everything that's going on globally with this pandemic and debt and MMT and all sorts, if you were in your 20s or 30s as, you know, a young family man, would you be very optimistic about, first, your future, and second, the overall future of societies, I suppose?
Yeah, pessimism is futile.
Yeah.
It's wild. But as individuals, we are so creative, so tenacious, so kind, generally, I'm not talking about everybody, that individually we create at a faster rate than collectively we destroy. It takes real effort in the United States for individuals. Kids commandeering a garage in Sunnyvale, California, out pops Google. The truth is that we create so much value individually that we can afford our collective stupidity. And that will continue. I had it substantially better than my parents, who had it substantially better than my grandparents. And I'm not trying to say that we aren't going to face a reckoning. I'm not trying to say that we won't face a 50 or 60% decline in equities prices. It's highly likely that we will. Buffett says they occur sort of every 10 years. We need to resolve this debt. The easiest way to do it is for the young people to repudiate it. The young people who are listening to your show need to understand that what has happened is that old people like me voted ourselves all kinds of cool benefits: Medicare, Medicaid, Social Security, all kinds of stuff. I mean, all kinds of stuff, but we didn't pay for it. We left the kids the tab. It's hilarious to me that most kids are voting progressive, because what they're really saying is, kick me one more time, Rick. You know, vote yourself a whole bunch more benefit and leave me the bill. Now, when I say that makes me positive, it does, because what young people should say to old people like me is, you voted yourselves all this shit, you pay for it. Right? If you took, I'm not saying it's going to happen, but if you took $120 trillion in recourse liability and you reduced it you reduce it two ways. You either have an honest default, which you say, we ain't going to pay, or you have a dishonest default. You inflate away the purchasing power of the obligation. So I feel pretty good about things going forward. I just think that we have a couple of reckonings to get through first. But young people who work, who study, who compete with other young people who don't work or study, are going to get ahead really without trying. And the technology that young people have to employ today, relative to even what happened when I was a young person, means that the tools that are available to you today are incomparably different. I remember very well in my 20s doing securities analysis, getting 5 years of quarterly reports, pulling the staples out of them and laying them out, usually on the floor, so that I could study the progression of the income statement and the balance sheet over time on my hands and knees. I can go to the EDGAR or CEDAR database, depending on the origin of the company, and even an old Luddite like myself, with a couple of keystrokes, can accomplish in 7 or 8 minutes what used to take me 4 weeks. And it's only getting better. When I was coming up, when I was studying or when I was teaching, I had to get on planes. I had to subject myself to the indignities of customs. I had to go to strange hotels. Now I talk to you wherever you might be over this wonderful medium, Zoom. These are examples of the tools that young people have access to that make them more efficient, that allow them to create greater utility than has ever been available before. You need to understand too that if one of your fears is our collective stupidity, there's no law that says you have to be stupid yourself. Just because everybody about you is going about harming themselves in terms of their financial future or their health, there's no requirement that you be as stupid as your neighbor.
Yeah, I think that's it's just, I think sometimes for some people it's hard to when you look at all the news and the varying debt piles and so on. I suppose for young people, knowing that they're footing the bill, it can be hard to think positively about the future, but in great uncertainty there's great opportunity as well.
I agree. I think that the opportunities in front of us are greater than the risks. Remember that the real risks are collective and the opportunity is individual. So to the extent that you see the risk as being collective, to the extent that you can divorce yourself from that risk, you're well advised to do it.
And that might include diversifying your life or decentralizing certain aspects, and
at the very least control what you can. Worry about how you can create utility for others. And if you do that, everything else will take care of itself. Yes, by all means, be prudent in terms of taking on social obligations, but worry first about getting ahead yourself.
Okay. All right. I think we've been on for almost an hour now. I don't know if you've got other obligations.
I do, in fact, but
okay. Well,
I have 9 minutes before I have to be smart for someone else.
Okay, maybe just a few last words of I don't know, advice for young people that want to invest.
I mean,
the books.
The best were the books, but anybody who is a viewer of yours may know that I'm happy in terms of carrying on a discussion around natural resource stocks by doing it around your audience's own portfolios. If you go to a website, sprottusa.com/rankings, and list your natural resource stocks, please, by the way, no technology stocks, no cannabis stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. And I'll include copies of the Barron's Gold Mining Index, which is the chart we talked about earlier, and also a 100-year commodity chart, which talks about how cheap commodities are in real terms against other asset classes going back 100 years. I found the easiest way to teach lessons to investors is to teach them lessons based on their own portfolios where they have real non-esoteric interest. So once again, sprottusa.com/rankings.
sprottusa.com/rankings. Just to repeat that. That sounds great. Thanks for that. Maybe you'll be able to let me know if any of my subscribers have indeed invested in some of my recommendations, of which Sprot's products are part of it.
It would be very useful if in the comment section of the source section, they mentioned Francis Holmes so that I can differentiate them from other audiences.
Okay, we'll try to do that.
Great.
Thanks so much for taking the time to speak with us today.
Pleasure.
Hopefully, maybe at some point in the future, we can do this again.
I look forward to it. Thank you.
All right. Thanks a lot, Rick.
Thank you.
Take care.
Bye-bye.